Preparing for a CEZ FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to join CEZ as an FP&A analyst. I would describe my experience in budgeting, forecasting, variance analysis, and management reporting. At CEZ, I would connect financial performance with operational drivers such as electricity prices, generation volumes, fuel costs, carbon allowances, and plant availability. I am strongest when translating data into decisions, explaining deviations, identifying risks, and recommending actions. I also value strong controls, clear communication, and practical Excel or planning system skills. CEZ's scale and energy transition agenda make the role especially motivating. While answering, focus on budgeting, forecasting, variance analysis, business partnering, and your interest in CEZ's energy operations, including generation, electricity prices, fuel costs, capital investment, and sustainability. Question 2. How would you build an annual budget for a CEZ business unit? I would begin with the prior year actuals, normalize unusual items, and establish a clear timetable and ownership matrix. Then I would collect operational assumptions, including production, realized power prices, fuel, emissions, headcount, maintenance, and capital expenditure. I would build an integrated budget, test base, upside and downside cases, and reconcile the income statement with cash flow and balance sheet impacts. Finally, I would challenge assumptions with business owners, document approvals, and establish monthly monitoring against the plan. Make sure to cover the budgeting timetable, historical baseline, operational assumptions, stakeholder input, scenario analysis, review cycles, approval controls, and alignment between income statement, balance sheet, cash flow, and strategic priorities. Question 3. How do you approach monthly variance analysis? My approach is to identify material variances first, then decompose them into understandable drivers. For an energy business, I might separate generation volume, realized power price, fuel, carbon, maintenance, and timing effects. I compare actuals with both budget and latest forecast, validate explanations with operational owners, and distinguish recurring issues from one-offs. I present the financial impact, root cause, and recommended action rather than simply reporting a percentage variance. That makes the analysis useful for decisions. In your answer, talk about separating price, volume, mix, timing, foreign exchange, and one-off effects, quantifying material variances, validating explanations, and converting findings into management actions. Question 4. What is the difference between a budget, forecast, and latest estimate? A budget is the approved financial plan and performance target for a defined period. A forecast is management's updated view of expected results, incorporating actual performance and revised assumptions. A latest estimate is usually the most current forecast used for near-term decision-making, often with a shorter horizon. I would preserve the original budget for accountability while refreshing the forecast when prices, production, costs, or project timing change. Comparing all three shows both performance and expectation changes. Be sure to mention that the budget is an approved target, the forecast is a periodically refreshed outlook, and the latest estimate supports current decisions using updated assumptions without rewriting accountability. Question 5. How would you forecast revenue for an electricity generation business? I would model revenue by asset and revenue stream rather than applying one growth rate. Key drivers would include available capacity, expected generation, maintenance outages, capacity factors, contracted volumes, merchant exposure, realized power prices, hedging arrangements, and ancillary revenues. I would reconcile forecast production with technical and commercial assumptions, then use market price scenarios to assess sensitivity. I would also check currency effects and timing. The result should explain not only the revenue number, but the operational and market drivers behind it. Focus on linking revenue to generation volume, availability, capacity factors, contracted and merchant prices, market curves, hedging, ancillary revenues, currency, and scenario sensitivities. Question 6. How would changing electricity prices affect CEZ's financial forecast? Higher electricity prices generally increase revenue and EBITDA for unhedged generation, but the impact depends on hedging and contract timing. I would identify the volume exposed to market prices, apply the relevant price change, and separately model fuel, carbon, and balancing costs. I would also assess downstream effects on cash flow, taxes, working capital, and investment capacity. For management, I would show sensitivities around the base case and distinguish realized prices from forward market assumptions. Make sure to cover direct revenue sensitivity, hedged versus unhedged exposure, fuel and carbon interactions, operating leverage, cash flow, valuation implications, and scenario or sensitivity analysis. Question 7. How do fuel and carbon costs influence an energy sector forecast? Fuel and carbon costs can materially change generation margins because they scale with output and plant efficiency. I would estimate consumption using production volumes and technical heat rates, then apply market or contracted fuel prices. Carbon expense would depend on emissions intensity, output, allowance prices, and purchased versus allocated permits. I would model hedging and timing separately, compare plant economics across technologies, and show the resulting impact on EBITDA and dispatch decisions. This connects operational planning directly to profitability. In your answer, discuss consumption rates, fuel prices, emissions intensity, allowance prices, generation dispatch, hedging, pass-through mechanisms, and the relationship between costs, margins, and operating decisions. Question 8. What KPIs would you monitor for CEZ's FP&A function? I would monitor EBITDA, operating cash flow, free cash flow, net debt, leverage, capex, and forecast accuracy. Operationally, I would track generation volumes, availability, capacity factors, realized power prices, fuel and carbon costs, outages, and project milestones. For sustainability-related activities, emissions intensity and renewable capacity additions may also matter. I would avoid viewing KPIs in isolation. For example, higher generation is not positive if margins decline because fuel or carbon costs increase. The dashboard should support action. Be sure to mention financial KPIs such as EBITDA, cash flow, leverage, and capex, alongside operational measures including generation, availability, capacity factor, realized prices, safety, emissions, and project delivery. Question 9. How would you analyze a major capex project at CEZ? I would first understand the project's strategic purpose, expected capacity, construction schedule, and commercial model. Then I would build cash flows covering development costs, construction capex, operating costs, revenues, taxes, working capital, financing, and decommissioning where relevant. I would calculate NPV, IRR, payback, and downside sensitivities for price, delays, cost overruns, availability, and regulation. I would also define stage gate approvals and compare actual outcomes with the investment case after completion. That strengthens future capital allocation. Focus on strategic rationale, total investment, construction timing, operating assumptions, NPV, IRR, payback, funding, risks, sensitivities, stage gates, and post-investment review against approved expectations. Question 10. How do you distinguish a cash flow forecast from an income statement forecast? The income statement measures performance using accrual accounting, while the cash flow forecast estimates when money actually enters or leaves the business. A profitable month can still create a cash shortfall because of receivables, inventory, payables, capex, taxes, debt service, or collateral requirements. I would forecast operating cash flow from earnings and working capital, then add investing and financing flows. Reconciling profit to cash helps identify liquidity needs and prevents management from confusing accounting earnings with available funds. While answering, explain accrual versus cash timing, working capital, capex, financing, taxes, non-cash items, and the importance of reconciling profit, liquidity, and funding requirements. Question 11. What would you do if actual results significantly missed the forecast? I would first confirm the data, accounting treatment, and timing before drawing conclusions. Next, I would quantify the miss by driver, such as price, volume, outage, fuel, project delay, or cost overrun, and determine whether it is temporary or structural. I would discuss findings with the responsible business owners, communicate implications early, and update the forecast transparently. Finally, I would agree corrective actions and capture the lesson in future assumptions, thresholds, or reporting processes. Accuracy improves through feedback, not concealment. In your answer, cover immediate validation, materiality assessment, root cause analysis, communication, forecast revision, corrective actions, and lessons learned to improve assumptions, ownership, and reporting controls. Question 12. How would you improve a slow or error-prone Excel planning model? I would map the current workflow and identify manual uploads, duplicated calculations, hard-coded assumptions, and unnecessary file size. I would separate inputs, calculations, outputs, and checks, standardize account and entity mappings, and reduce volatile formulas. Where appropriate, I would automate data imports using Power Query or planning system connections. I would add control checks, clear documentation, version discipline, and user testing before changing production files. The objective is not complexity, it is a reliable model that users can understand and maintain. Make sure to mention model architecture, standardized inputs, formulas, checks, version control, documentation, automation, user testing, and preserving transparency for reviewers and business stakeholders. Question 13. Describe a time you explained financial results to a non-finance stakeholder. In a previous reporting cycle, a business manager questioned a cost variance because the percentage appeared unusually high. I converted the analysis into operational drivers, separating a one-time maintenance charge from recurring supplier inflation and timing differences. I used a simple bridge rather than accounting terminology, explained the impact on the full-year forecast, and asked the manager to validate the assumptions. We agreed an updated outlook and a monitoring action. That experience reinforced that FP&A creates value by making financial information usable. Focus on simplifying technical analysis, using operational language, tailoring the message to the audience, highlighting business consequences, checking understanding, and agreeing clear follow-up actions. Question 14. How would you build a downside scenario for CEZ? I would select a coherent set of downside drivers rather than independently stressing every line. For example, lower power prices could coincide with weaker generation, higher carbon costs, an extended outage, and delayed project spending. I would document each assumption, link it through revenue, margins, cash flow, capex, and leverage, and check for double counting. I would then quantify the gap to funding or targets and identify mitigations such as cost control, maintenance rescheduling, hedging, or investment reprioritization. Be sure to cover selecting realistic adverse drivers, linking assumptions through the model, avoiding double counting, quantifying liquidity and covenant effects, defining mitigations, and presenting probability or sensitivity clearly. Question 15. What is driver-based planning, and why is it useful in FP&A? Driver-based planning builds financial forecasts from measurable operating assumptions instead of applying arbitrary percentage changes. For a power asset, generation might depend on capacity, availability, and load factors, while revenue depends on output and realized price. Costs can be linked to fuel consumption, emissions intensity, headcount, or maintenance schedules. This approach improves transparency because owners can challenge the drivers directly, makes scenarios faster to run, and helps management understand what operational actions will change financial outcomes. In your answer, define operational drivers, explain their relationship with financial outcomes, contrast them with arbitrary percentage adjustments, and discuss transparency, speed, ownership, and scenario flexibility. Question 16. How would you ensure consistency between management reporting and statutory accounting? I would establish a controlled mapping between statutory accounts, management reporting lines, entities, and cost centers. Each month, I would reconcile reported revenue, EBITDA, assets, liabilities, and cash movements, investigating differences caused by eliminations, reclassifications, accruals, or international financial reporting standards adjustments. I would align reporting deadlines with the close calendar and document recurring bridge items. Management reporting can use additional operational views, but the underlying numbers should be traceable, approved, and reconcilable to the general ledger and consolidation output. Focus on reconciliations, chart of accounts mapping, accruals, eliminations, international financial reporting standards adjustments, consolidation rules, close calendars, documentation, and investigating differences rather than forcing artificial agreement. Question 17. How would you assess forecast accuracy and improve it over time? I would measure forecast accuracy using absolute and percentage errors, but I would also test bias to see whether forecasts systematically overstate or understate outcomes. I would analyze accuracy by line item, business unit, driver, and forecast horizon. For example, price assumptions may be market sensitive while maintenance timing may be execution sensitive. I would discuss root causes with owners, recalibrate assumptions, and improve data quality. The goal is not merely a better score, it is a forecast that supports better decisions. Make sure to mention forecast versus actual metrics, bias, error by driver and horizon, materiality, root causes, accountability, recalibration, and distinguishing controllable performance from uncontrollable market movements. Question 18. What would you do if a senior manager asked you to make the forecast look more favorable? I would clarify whether the request concerns an achievable target, a management ambition, or the most likely forecast. I would keep the base forecast supported by evidence and present an upside case separately with explicit actions and assumptions. I would explain that overstating results can damage credibility, resource planning, and decision quality. If pressure continued, I would document the assumptions and follow the appropriate escalation or review process. Professional FP&A requires constructive challenge, especially when the information affects funding or risk decisions. While answering, emphasize integrity, documented assumptions, transparent scenarios, escalation when necessary, separation of target and forecast, and respectful communication focused on decision usefulness. Question 19. How can FP&A support CEZ's energy transition and sustainability investments? FP&A can translate the energy transition strategy into quantified investment plans, operating forecasts, and measurable milestones. I would model renewable capacity additions, expected generation, power prices, connection costs, subsidies, operating expenses, carbon impacts, financing, and construction risk. I would assess NPV and downside cases while tracking emissions intensity, project delivery, and safety alongside financial returns. This prevents sustainability from being treated as a separate narrative. It becomes part of capital allocation, performance management, and long-term value creation. Focus on integrating strategy with financial planning, renewable capacity, emissions, regulatory assumptions, long-term returns, funding, scenario analysis, and balanced scorecards covering both financial and non-financial outcomes. Question 20. What would your first 90 days as a CEZ FP&A analyst look like? During the first month, I would learn CEZ's businesses, reporting calendar, planning systems, chart of accounts, key KPIs, and major forecast drivers. I would meet finance and operational stakeholders to understand their needs and responsibilities. In the second month, I would support recurring reporting, validate data flows, and review existing models and controls. By the third month, I would aim to deliver one practical improvement, such as a clearer variance bridge or automated report, while building trust through accuracy and responsiveness. Be sure to mention learning the business and reporting calendar, understanding systems and data, meeting stakeholders, reviewing models and controls, delivering early improvements, and building credibility through accurate, useful analysis. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.